Welcome to CoreLogic's housing market update for April 2017. Capital gain conditions across the housing market have continued to gather pace, with CoreLogic reporting capital city home values rose by a further 1.4% in March to be 3.5% higher over the March quarter and 12.9% higher over the past 12 months. The annual rate of growth was the highest since May 2010. Dwelling values have been surging higher since the middle of 2016, when the cash rate was lowered by 50 basis points and when investment demand started to rebound after slowing through most of 2015 and the first half of 2016. While the resurgence of capital gains is mostly evident in Sydney and Melbourne, where the annual rate of growth has jumped to almost 19% in Sydney and 16% in Melbourne, the smaller markets of Canberra and Hobart are also seeing an acceleration in the rate of value growth. Adelaide and Brisbane continue to record a more sustainable growth rate, while dwelling values have continued to trend lower in Perth and Darwin on both a quarterly and an annual basis. There are plenty of reasons why the Sydney and Melbourne housing markets are showing such substantially higher rates of capital gain compared with other markets. However, the broad factors relate to the high rate of population growth in these cities, the strong jobs market, which is reflective of the buoyant services and construction sector, and the large number of investors that are adding to housing demand in these cities. Over the past 12 months, New South Wales and Victoria have accounted for just over 2/3 of the nation's population growth. The long-term average suggests a normal share of population growth in these two states is about 51%. Such strong population growth is a significant contributor to housing demand. The past 5 years has seen New South Wales and Victoria comprise 3/4 of the national number of jobs created. The long-term average is substantially lower at just 55%. Finally, investment demand across New South Wales and to a lesser extent in Victoria is substantially higher than in other states. Based on January data from the Australian Bureau of Statistics, investors were responsible for almost 60% of housing finance commitments, that's excluding refinanced loans, across New South Wales and 46% across Victoria. The latest housing market results have been accompanied by new policy announcements from the Prudential Regulator, APRA, and the Australian Securities and Investments Commission, aimed at reducing the amount of new loans being originated on interest-only repayment terms. The APRA policy requires Australian lenders to reduce the proportion of new residential loan originations for interest-only loans from the current rate of almost 40% to no more than 30%. These policies are likely to dent investment activity in the housing market. However, when taken in context with the other market disincentives, there is the potential that investment exuberance could slow more sharply. Investors are already paying a 40 basis point premium on their mortgage rates, and this could increase further if APRA requires lenders to hold more capital against their residential mortgages. Additionally, rental yields are falling to new record lows each month, which indicates that dwelling values are out of balance with rents. Regulators are also likely to be mindful of the timing of an investor slowdown though, and will most probably be careful not to dial back investor demand too swiftly. The unprecedented level of new unit supply that's currently under construction is highly reliant on investors being able to settle their off-the-plan contracts. Settlement risk is already heightened across some key inner-city unit markets, and a further tightening in investment lending policies has the potential to create some challenges for the 150,000 or so units that will be transitioning from the construction phase to settlement. If investment demand does trend lower, we should expect to see the pace of capital gains to respond to the diminishment of demand. The growth cycle has been running now for almost 5 years, and it's rare for a housing market to experience such a long and strong growth cycle. In isolation, the additional lending policies are likely to have a relatively minor effect on housing market conditions. However, when viewed in conjunction with the affordability constraints in the market, with low rental yields and with rising mortgage rates, as well as against a backdrop of low wages growth and record high levels of household debt, it's looking more likely that the housing market is approaching a peak. If you're interested in keeping up to date with the housing market, check out our regular reporting at www.corelogic.com.au.